Welcome to CoreLogic's update on housing market conditions for December 2016, brought to you by Smartline Personal Mortgage Advisors. This month, we're providing a wrap of November's hedonic index results, as well as some focus on housing supply and investment levels, which are once again moving higher since the recent round of rate cuts in May and August earlier this year. Capital city dwelling values edged a further 0.2% higher in November, according to the CoreLogic Home Value Index. Although values rose in November, the month-on-month change was the lowest since December last year, potentially indicating that the re-acceleration of housing market growth rates, which has been evident over the second half of 2016, may be starting to abate. The softer monthly result was largely attributable to a weak performance within the Melbourne unit market, where values were 3.2% lower over the month and they were down 1.1% over the rolling quarter. Although the pace of capital gains has moderated compared with previous months, the stronger growth conditions across most of the capital cities since the May and August rate cuts have pushed the annual trend of growth higher. The combined capitals index is up 9.3% over the past 12 months, after recording an annual growth rate as low as 6.1% in July earlier this year. Sydney, where dwelling values were 13.1% higher, and Melbourne, which is up 11.3%, are both once again recording double-digit annual growth, while Canberra and Hobart are now recording annual growth rates higher than 8%. Brisbane and Adelaide have been relatively immune to the improved growth conditions, with annual capital gains tracking around 4 to 5% higher across both cities. Perth is the only market where values remain lower than a year ago. Over the past 12 months, Perth dwelling values have fallen by 3.4%, taking the cumulative decline to 9.2% since values peaked back in December 2014. The Sydney housing market hasn't seen anywhere near the same differential of growth rates between houses and units like what we're seeing in Brisbane and Melbourne. House values across Australia's largest city are up by 13.5% compared with a 10.8% rise across the unit market. Although the Sydney metro area is recording a similar number of approved units in the pipeline as Melbourne, the development trend is much more geographically diverse compared with the other cities. Plus, Sydney has a well-developed densification trend, with attached housing construction outpacing detached homes since the mid-1990s. With dwelling prices approaching a median of $900,000, it's likely that many prospective buyers are being affected by affordability constraints in this market. Conditions across Sydney's rental markets remain relatively flat, providing a more affordable housing option for those who choose to rent. Overall, the housing market remains diverse, and despite the month-on-month fall in dwelling values across Melbourne, the two largest capital cities continue to set the highest trend pace for capital gains. Strong economic conditions, including jobs growth and high migration rates, have been a large part of the housing market's success in these cities. Concerns around unit supply do appear to be weighing down the performance of the unit market in Melbourne and Brisbane, though, so it's arguably good news to see dwelling approvals showing a trend towards fewer high-rise units. According to ABS data, unit approvals were down by 23.5% in October to be 41.8% lower compared with October 2015. House approvals, which tend to show a steadier trend, were down 2.5% over the month to be 4.5% lower compared with a year ago. While approvals remain high compared with the long-term average, it's becoming increasingly clear that approved dwelling supply has moved through the peak of the cycle, suggesting the construction pipeline is likely to follow suit over the coming year. While dwelling values were generally rising in November, rental rates have remained relatively subdued. Capital city rents were down 0.5% over the past 12 months, while dwelling values are up by 9.3%. The byproduct of lower rents and substantially higher dwelling values has been further compression in the rental yield. The typical capital city house is now returning a gross rental yield of 3.1%, and units are showing an average gross yield which is slightly higher at 4.1%. Yields have fallen the most substantially across the markets where capital gains have been the highest, in Sydney and Melbourne. The average gross yield on a house in both cities is now 2.8%. However, with steep falls in Darwin unit values, the capital city of the top end is now showing the lowest gross rental yields for units at 3.6%, although Sydney isn't far behind at 3.8%. With rents showing no signs of accelerating higher and dwelling values still trending upwards, the likelihood is that rental yields will continue to reduce to new record lows over the coming months. The low yield profile doesn't seem to be a concern to investors, with housing finance commitments for investment purposes tracking consistently higher over recent months. Since May, which coincided with the first of the two rate cuts this year, the value of investor housing finance commitments has risen by 14.5%. Excluding refinance loans, investors now comprise 49% of all new housing finance commitments. Investors are the most active in New South Wales, where investors account for 57% of mortgage demand across the state. Tasmania is attracting the smallest proportion of investment activity, with finance commitments for investment purposes comprising 28% of the Tasmanian market. It appears that investors are focusing their strategies on areas that have demonstrated high capital growth with little concern about the low yield profile. With other asset classes such as cash or bonds offering shallow returns and equity markets still showing a high amount of volatility, it's easy to understand the investment appeal of housing. Total returns, which include capital gain as well as the gross yield, are generally above 8% per annum across each of the capital cities, except for Darwin and Perth, where the yields and the capital growth have been lower. Another facet of the housing market that has changed over recent months has been transaction numbers. The number of settled sales reached a recent low point in August earlier this year at approximately 36,000 settlements over the month. Since that time, settled transaction numbers have increased, rising by about 16.4% nationally to the end of November and 21% higher across the combined capital cities. The bounce back in sale numbers could be the result of higher buyer demand fueled by the August and May interest rate cuts. If this is the case, renewed speculation that interest rates could move higher next year may dampen some of this renewed enthusiasm. Most economic commentators are aligned that the rate cutting cycle may be over. Additionally, the ASX cash rate futures market is indicating that traders are also speculating that interest rates may move higher over the coming year. If we do see rate hikes in 2017, the likelihood is that they will be gradual and limited only to modest increases. The Reserve Bank is likely to be wary of increasing the cost of debt at a time when the domestic economy is still relatively fragile and the level of household debt is at record highs. As always, you can find a vast amount of housing market research at our website, www.corelogic.com.au. From all of us at CoreLogic, we wish you happy holidays and a prosperous new year in 2017.